before you invest a single dollar of your hard-earned money, before you open a brokerage account, before you listen to a friend, coworker, or social media influencer telling you what stock will explode, you need to understand something far more important than a hot tip. You need to understand the vehicles that carry your money through the market, because the vehicle you choose can shape your financial future for decades. In this video, you will clearly understand the difference between index funds, mutual funds, hedge funds, and ETFs. You will learn how each one works, who manages it, how fees are charged, how trades happen, what level of risk is involved, and which one usually works best for everyday investors in the United States who want to build long-term wealth. By the end, you will not only understand these fund types, you will understand how smart investors actually think. Let's start with a simple question. What is a fund? Imagine 100 people who all want to invest in the stock market. Each person has some money, but not enough to buy many different stocks. If each person invests alone, they might only buy 2 or 3 companies. That creates risk, because if one company performs badly, the entire portfolio suffers. Now, imagine those 100 people combine their money into one big pool. With that large pool of money, they can invest in hundreds of companies across many industries. Each person owns a small piece of the entire basket. If one company struggles, other companies may perform well and balance things out. The shared pool of money is called a fund. A fund simply collects money from many investors and invests it using a defined strategy. Now let's talk about index funds. An index fund is designed to copy a market index. A market index is basically a list of companies that represents part of the market. For example, the S&P 500 represents 500 of the largest companies in the United States. When people say the market is up, they are often referring to this index. An index fund simply buys the same companies that exist in that index. It does not try to guess which company will win. It does not try to predict the future. It simply follows the market. If the index rises, the fund rises. If the index falls, the fund falls. This strategy is called passive investing. Because there is no large team constantly researching stocks, the costs stay very low. Low cost is extremely important because fees reduce long-term returns. Even a 1% difference in annual fees can remove thousands of dollars from your future wealth. Index funds are also popular because they offer instant diversification. Instead of relying on a few companies, you own small pieces of hundreds of businesses across industries like technology, healthcare, banking, retail, and energy. Another detail is how index funds trade. Most traditional index funds process buy and sell orders once per day after the market closes. The price is calculated using the net asset value, which is the total value of the investments inside the fund divided by the number of shares. Long-term investors usually do not worry about daily price movements because their goal is growth over many years. Now, let's discuss mutual funds. Mutual funds also pool money from investors, but most of them are actively managed. That means a professional manager and a team of analysts study companies and decide which investments to buy or sell. Their goal is to beat the market rather than just match it. They examine company profits, industry trends, economic conditions, and many other factors. Active management sounds appealing because experts are making decisions for you. However, it comes with higher costs. Analysts must be paid, research costs money, and frequent trading creates additional expenses. Because of this, mutual funds usually charge higher fees compared to index funds. Some investors still choose mutual funds because they believe a skilled manager can outperform the market or because they want specialized investment strategies. Now let's talk about hedge funds. Hedge funds are very different from index funds and mutual funds. They are usually private investment partnerships designed for wealthy investors or large institutions. Hedge funds often use aggressive strategies such as short selling, which means betting that a stock will fall. They may also use borrowed money called leverage to increase potential returns. Some hedge funds trade currencies, commodities, or complex financial instruments. These strategies can sometimes generate high returns, but they also involve high risk. Hedge funds are also known for high fees. The traditional structure is called 2 and 20, which means a 2% management fee plus 20% of the profits. Because of the complexity, risk and high-cost hedge funds are usually limited to investors who have significant wealth. Finally, let's talk about ETFs, which means exchange-traded funds. ETFs are often described as a mix between index funds and individual stocks. Like index funds, they hold a basket of investments, such as stocks or bonds. Many ETFs simply track an index, which keeps costs low and diversification high. The key difference is that ETFs trade on stock exchanges during the day, just like regular stocks. This means investors can buy or sell them anytime while the market is open. Their price changes throughout the day depending on supply and demand. Because of this flexibility, ETFs have become extremely popular among investors. So, how do you choose between these options? First, think about your goals. If you are investing for the long term and want something simple, diversified, and low cost, then index funds or ETFs are often a strong choice. If you believe in active management and are willing to pay higher fees for the possibility of better returns, then a mutual fund might interest you. If you are a wealthy investor willing to take large risks with complex strategies, then hedge funds might be an option. But here is the deeper truth about investing. Success usually does not come from complicated strategies. It comes from discipline, patience, and consistency. The US stock market has gone through recessions, crashes, wars, and financial crises. Yet, over long periods, it has continued to grow as businesses innovate and expand. Investors who stay patient and continue investing during difficult times often benefit the most. Emotions can be dangerous for investors. Fear during market drops can cause people to sell at the worst time. Excitement during market booms can push people to chase overpriced investments. A simple diversified strategy helps reduce emotional decisions. Think of investing like planting a tree. You water it consistently and give it time to grow. You do not dig it up every few months to check the roots. Over time, that tree grows stronger and larger. When you simplify everything, the comparison becomes clear. Index funds are passive, low cost, and designed to match the market. Mutual funds are actively managed and usually have higher fees. Hedge funds are private, high risk, and expensive, but sometimes pursue aggressive returns. ETFs trade like stocks while still offering diversification and low costs. Now bring this idea back to your own life. If you are working a regular job, saving money every month, and investing for the future, you do not need complicated strategies. What you need is consistency. Regular contributions, diversified investments, and patience over many years can quietly build powerful wealth. Here is the moral lesson. Do not chase complexity. Do not assume expensive strategies are smarter. Understand what you own, understand what it costs, and stay disciplined. Wealth is rarely built overnight. It is built through small, smart decisions repeated over time. If this explanation helped you understand the difference between index funds, mutual funds, hedge funds, and ETFs, and you want more simple knowledge about money, investing, and financial growth in the United States, make sure you subscribe to the channel Arsam Explains Money.